Greetings, folks. This is DC Investing. I've reached financial independence and I'm talking about subjects to help others on their journey for financial independence. And today I wanted to talk about margin investing. And I'm mainly going to just be talking about some ideas out loud. And, I have for many, decades been more aligned with the Dave Ramsey approach where debt is bad. You don't want to be in debt. I was somebody who paid off my house early. I've never carried credit card debt. I paid off cars early. I did have some student loan debt and paid that off within, I don't know, 2 or 3 years after I graduated school. All of that happened a long time ago, and I've just always followed that mantra of never do debt, never do debt, never do debt. Now, looking back over the past couple decades, I have seen instances where I would actually be further ahead financially if I had embraced more debt. And so a couple of those is in the financial crisis after 2008, the whole market scared me, and that was the time that I ended up paying off my house. But looking back, had I, instead of paying off my house, just invested those funds, I would have made a larger gain than the benefit of paying off my house. Now, there's something to be said about knowing you're safe and secure in your house, but had I bought stocks, I could have just invested in the S&P 500 in 2010. We've had a tremendous growth in the market. And just kind of looking back, at a 3.5% interest rate for a house loan, if I'm making 5 to 10% or even more from an investment portfolio, I would have made a whole lot more had I used some debt to my advantage and, come off, I guess, out ahead. The second time that really worked was in 2020. And I remember kind of thinking about it saying, hey, interest rates are really low. I think I get a loan for like 3% or something. Should I mortgage the house and then invest it? And I didn't end up doing that. There's something to be said about feeling secure in the in the place that you live. But just kind of since the 2020 timeframe, I kind of look at the things that I've been investing in and what the difference would have been. Now, I got interested in oil pipelines and energy stocks, and they've done really well over the past year. So if I had taken, the $500,000 out of my house, invested it in oil pipelines and energy stocks, I think over the past year, I've actually had a return of about 32% on average for the past 5 years. So, if that mortgage cost 3%, but I made 30% in investment increase, that's a huge difference. I like the pipelines because they pay really high dividends. They're like 7.5% on average. So even if I didn't get a capital gain, it would have worked financially to pull a loan and just invest the difference and then just slowly pay off the house because the interest is such a low rate. So while I'm really conservative, I got to appreciate the idea that, hey, borrowing money in order to invest, if you can do it wisely and get a gain, is a better use of capital than, just paying off a house. So, I have to respect that. So in the light of that, this year I'm toying with doing a margin loan, and I moved some stocks over to Robinhood, moved about a couple $100,000 over there, and I have a margin balance right now of about $125,000. I have paid or purchased somewhat conservative investments. I bought master limited partnership oil pipelines. They all pay dividends from 8.5 to 9.5%. My margin loan interest rate is 5.5 or 5.25%. So I'm getting an arbitrage just on the dividend yield of about 4%, which I think will slowly over time end up doing giving me a good gain overall from that margin loan. But I kind of have to think, if you take a step back, if you take this to extremes, what would happen if every paycheck for your W-2 job, instead of paying your bills with your paycheck, you took it and bought stock, maybe the S&P 500 with it. Then to pay your bills, you took out a margin loan against those shares to to pay off those bills. So, it's always, you can get a margin call, and you always got to be careful and just have enough funds so that if the market fell by 50%, you would still be safe in your investments. But, so know that with a grain of salt. But like if you had $50,000 worth of bills, but instead you took your $50,000 and bought $50,000 worth of stock, that then gave you $50,000 worth of margin buying power, turned around, pulled a margin interest loan, paid off your bills, you basically end up with, you have $50,000 worth of stock, you paid off your $50,000 of bills, you have margin interest cost of 5.25%, and then, the market has been doing well over the past while. So this year to date, it is up 10 or 11% or something. So a margin loan would have cost you half of 5.2%. So let's say it's 2.5 or a little bit more. The market's up 10%. Your margin loan costs you 2.5%. You get to pocket the difference. Over the course of a year, there's no guarantees. Who knows what will happen to the market? And that's the risk, is you don't know. But let's say the market goes up by 15%. You pay your margin loan of 5.25%, and thus you make 5%. And you can continue to do this year after year, which is what I've heard that, Elon Musk and Jeff Bezos do. Their shares appreciate over time so much that it makes more sense for them to borrow against their shares than it does for them to pay off debt. So me looking at this from a really conservative investing perspective, it's just interesting to think that, hey, you could, I guess this thing is like, what is it, bed, earn, borrow, die, or something like that. I'm not sure how that acronym goes, but as long as your investments earn more than the cost of the margin, you come out ahead in this whole overall process. So, each year your margin loan costs you 5.25%. As long as your stock either appreciates more or pays you higher dividends than that 5.25%, using your funds to buy stock actually puts you further ahead over the long term than it does just being conservative and paying off your debts and your bills. So that's really interesting to kind of think about. And I'm wrapping my mind around it. I am trying that a little bit this year. I took out a margin loan for the first time in my whole life, and I'm experimenting with this concept. But the math kind of works out, and it also helps with your overall taxes too, because for every dollar you earn at a W-2 job, your tax rate's really high, whereas the dollar you earn in investing, your tax rate's much lower. So it's more tax efficient to get income from investing than it is to get income from working a job. Excuse me. Now, you do have to pay taxes on any gains that you get. Your margin interest can cancel out investment income that you earn. So kind of know that, but you have to itemize your deductions in order to do that. If you don't use a margin or don't use your margin interest in a particular year, you can kind of pull that forward, and you have to fill out a particular form. I haven't done this yet, but I'm learning about it. You have to push it forward to future years so that in a year that you are itemizing and have investment income, you can cancel it out with the margin that you ended up paying. And so it's just one of those tax strategies. But it gets kind of complex. You really have to be a good financial accountant to really figure this out and make it work. But I do think that there's something to be said about putting every dollar you possibly can into the stock market. Or you could do it other investments too, like rental property, real estate, or something else. And, as long as you have the ability to continue borrowing against those properties over the long term, as long as your investments continue to go up at a higher rate than what you're paying on your margin interest loan, it should be a benefit. And that's really just kind of an interesting thing to think about. So just, in the idea of talking about interesting financial subjects, I thought I'd, put that out for you guys today. What do you think about that concept of, using as much of your funds to buy investments as possible, and then pulling a margin loan to pay for your debts or your regular bills or whatever on top of that, and using the arbitrage between the potential gains you get from your investment appreciation versus what it would cost on a margin loan? So I don't know, thinking out loud here, but this channel is all about learning together, talking about topics that might help us in investing. And I can definitely see over the past years, like if I had mortgaged my house and bought stocks, I would have been further ahead. Or if I had mortgaged my house in 2010 and bought stocks, I would have been further ahead today. And the same works true with a margin loan. 5 years ago, if we took a margin loan out, well, the markets had really good returns since 2020. And you come out further ahead. And you got to be careful about down years. Like 2020 was really scary for a while. I wasn't invested as much in the market at that time. And 2022 was a down year, so you got to be ready for markets to go down. But overall, I think the math is solid as long as the markets continue to kind of appreciate, which there's no guarantee that they could. But what do you guys think? Have you ever tried this? What are your thoughts about margin investing? Would you rather stick with the Dave Ramsey approach and just never use debt? Pay it off, pay it off. It's the curse of the devil. What do you think? Leave a comment below, like and subscribe. Thanks for watching the channel. We'll see you. Bye.